Hi, everyone, and welcome. If you are self employed or a small business owner, chances are you've asked yourself this question: how much can I actually put into a solo 401k? Well, that's exactly what we are diving into today. And let me tell you, this isn't just about numbers, it's about how you can potentially supercharge your retirement savings with one of the most powerful tools out there for entrepreneurs. We're going to delve deeper into this today. As always, go ahead and type over your questions during the live webinar. We'll pause and answer those questions as they come in. Looks like we already have a few questions in the queue there, and we'll get to those here in a moment. As always, please like today's video. Please subscribe to our channel so that you receive notifications when we go live. We typically go live once a day, oftentimes twice a day. So, what we're going to cover today is going to be in connection with how much can I put into a solo 401k plan. The solo 401k contribution types: employee, employer, and voluntary after tax solo 401k contributions as part of the Mega Backdoor Roth solo 401k. Well, let's talk about those types of contributions. Let me share my screen here. And we will talk about that. Okay, so there are various types of contributions that can be made to a solo 401k plan. While not all solo 401k plan providers allow for all the contribution types that can be made to a solo 401k plan, here at my solo 401k financial, the plan that we offer is robust and that it allows for all contribution types under the IRS regulations. Some of those contribution types are employee contributions, which can be made up of employee pre-tax or employee Roth contributions. You also have employer contributions. Employer contributions can be made as pre-tax employer contributions or as Roth employer contributions. It used to be you could only apply employer contributions on a pre-tax basis, but Secure Act 2.0 changed that. And now you can also make employer contributions as Roth contributions. So it's commonly referred to as employer Roth solo 401k contributions. Then, of course, you have the voluntary after-tax solo 401k contributions, which are part of the Mega Backdoor Roth solo 401k strategy. So let's dissect each of these. So again, with with employee contributions, you can make those as pre-tax or as Roth employee contributions. For tax year 2025, the employee contribution limit is $23,500. And again, you can apply that as an employee Roth contribution or as an employee pre-tax contribution or in combination, meaning you could put some as employee Roth, some as employee pre-tax. You just cannot go over that $23,500 limit. Now for 2024, you still have time to make contributions, especially if you opened the solo 401k plan in 2024 or in prior years. You actually have until your business tax return due date plus extension to make both employee and employer contributions to the solo 401k for tax year 2024. What is more, even if you have not yet opened the solo 401k plan and you want to open it so that you can make 2024 year contributions, you can still do that to a degree where you're going to be able to make employer contributions as well as voluntary after-tax solo 401k contributions for tax year 2024, even if you open the solo 401k plan here in 2025, as long as you open and fund that plan by your tax return extension due date plus extension. So if you file for an extension, you still have time to make those 2024 contributions for 2024, both employee and employer. That's if you already had a plan. Now, if you open a plan for the first time here in 2025, and you'd open it by your business tax return extension deadline, you're going to be able to make contributions for 2024. The contributions, however, will be only employer and voluntary after-tax contribution. For example, let's say Janet has a S Corp self-employed business. She does not have a solo 401k plan. She decides to open a solo 401k now. Today is August 21st, 2025. She decides to open a solo 401k today so that she can make contributions for tax year 2024. So she can open the solo 401k today, and then open it and fund it by September 15 of 2025, which is the extended due date for an S Corp tax return due date. So she'll be able to make employer contributions as well as voluntary after-tax contributions for tax year 2024, even though she's just now opening the solo 401k plan here in 2025. Of course, she's going to have to base those contributions, the voluntary after-tax as well as the employer contribution, on her W-2 wages that she receives from the S Corporation for tax year 2024. So she already knows how much she received for 2024 in W-2 wages. So let's say she received $100,000 of W-2 wages for tax year 2024. She's going to be able to make an employer contribution of 25% of $100,000, so $25,000 for 2024. And then she can also do a voluntary after-tax solo 401k contribution of the difference all the way up to the overall limit of $69,000 for 2024. And then she can convert that to the Roth solo 401k or the Roth IRA. So we kind of jumped around there a little bit, but again, employee contributions can be made as pre-tax or as Roth contributions. And for tax year 2025, the overall limit of employee contributions is $23,500. We're going to talk about this catch-up amount of $7,500 for those who are age 50 or older, as well as the super catch-up contribution amount of $11,250 for those who are age 60, 61, 62, or 63 in 2025. Those are all actually indirectly connected to the employee contribution side of things. Okay, so let's take a look at some questions here, and then we'll pick back up again, and then we'll start talking about employer contributions. We just discussed employee contributions. Next, we'll discuss employer contributions. Here's some questions here. We've got a question from, give me a moment here. Looks like, here's a question. We are existing customers, S Corp with husband and wife on W-2. However, husband is leaving the firm to join new firm. We would like to bump up salary for wife so that total salary is same. Let's say wife's salary was 5,000 and now it's 10,000 per month. Can the employer contribution be bumped to $2,500? 25% of 10,000? So yes, number one, if your husband is leaving the existing business, that means obviously that if he works for another self-employed business, his own self-employed business, he can open a separate solo 401k plan. If not, then he can transfer his solo 401k funds out of the solo 401k plan to that new full-time employer plan if he's going to a full-time employer or even to an IRA. With respect to your contributions, now that you're going to remain in the business, your contributions will continue to be based on your W-2 wages. And all the contribution types, whether it's employee, employer, or voluntary after-tax solo 401k contributions, will be based on your W-2 wages. So, providing you perform the necessary material services to justify the W-2 salary that you're going to report, you can certainly increase your W-2 wages so that you can maximize contributions to your solo 401k plan. So if you're going to pay yourself, let's say $100,000 a year in W-2 wages, then you can contribute as an employer contribution 25% of that $100,000, which would be what, $25,000, 25% times 100,000. And then you could also make an employee contribution of 23,500. And then you can also make the difference up to the overall limit of $70,000 of the voluntary after-tax solo 401k contribution. So that's just one illustration of how you could divvy up those contributions. But in short, yes, you can contribute 25% of your total W-2 wages, depending on how much you pay yourself, which is going to be dependent on how much work you're doing in that self-employed business. So you'll want to work with your CPA and making sure that you report the necessary W-2 wages and justifiable W-2 wages as well. Thanks for your question. Okay, looks like we got a follow-up comment. Husband is going to daytime job. Does he have to transfer solo 401k to new employer 401k? Or can he keep it as is in case he returns back to the business? Good question. So since the business is not shutting down, in other words, you are going to continue with the business, then he is now required to transfer his solo 401k funds out of the plan, even if he is no longer working for the business. So he can keep the funds in the plan, or he can transfer them out. But the only time he would have to transfer those funds out or be forced to transfer them to an IRA or another 401k is if the business was shutting down. Obviously, the business is going to continue here. You are going to continue to work under that business. Okay, good question there. Looks like we have another question here from Ronnie. Again, please like today's video. Please subscribe to our channel so that you receive notifications when we go live. We typically go live at least once a day, oftentimes a couple times a day. Question, I'm going to open a solo 401k and move funds from my former employer sponsored account at Mailman. Can I only move a limited amount? Also wanting to open a Rob's 401k for a small business. Can I do both of these? So number one, yes, you can process a partial transfer from a former employer plan. You are not required to transfer all the funds. Second, in order to open a solo 401k plan, you have to be self-employed with no business owner, with no full-time W-2 employees other than yourself or your spouse who work 1,000 hours or more in any of your businesses. So if you have multiple businesses and any of those businesses employs full-time W-2 employees who are not owners in the business, then you would not be able to open a solo 401k plan for any of your businesses. With regards to the Rob's 401k, no, you would need to open up either the solo 401k or the Rob's 401k. Keep in mind the Rob's 401k plan is specific for funding your own business. A solo 401k cannot be used to directly fund your own business. With the Rob's 401k, the 401k buys shares of stock, common stock in your C corporation. Therefore, it becomes a shareholder / owner in your business, which requires separate reporting. What is more, you have to offer that plan to W-2 employees as well of that Rob's funded corporation, specifically those who work for the business for 12 months and work 1,000 hours or more. Great question. Okay, so looks like we don't have any other questions at the moment. Go ahead and continue to ask your questions, and then we'll pause and answer those questions as they come in. Let's see if and meanwhile, let me share my screen again, and we're gonna go back and continue talking about today's topic, which is how much can I put into a solo 401k plan? Okay, so we are going to pick up. We talked about employee contributions. Now let's talk about employer contributions. See what we have here. Employer contributions. So employer contributions, as I already detailed earlier, those can be made as employer pre-tax contributions, or they can be made as Roth employer contributions, or a combination of the two. So employer contributions, those are those are percentage based with respect to performing the calculation, whereas employee contributions are dollar for dollar with regards to the calculation. So let's do an example here. Let's say that your self-employed business is an LLC taxed as an S corporation. Let's further assume that for tax year 2025, you open a solo 401k plan and you plan to make employer contributions for tax year 2025. So calculating the employer contribution, which again is it's percentage based. When it's an LLC taxed as an S corporation, the calculation is based on 25% of your gross W-2 wages. So box 1 of your W-2 wages. So if you report 100,000 of W-2 wages from your self-employed LLC taxed as an S corporation for tax year 2025, you can contribute 25% of 100,000 as an employer contribution. So that would be $25,000. Now, one scenario is you can choose to make that 25,000 employer contribution as a Roth employer contribution. So that would get deposited into the Roth solo 401k bucket as an employer Roth solo 401k contribution. Now, when you treat that as an employer Roth solo 401k contribution, the S corporation gets a tax deduction on the employer side. So on the 1120S, you're going to report that as a tax deductible contribution, even though it went in as a Roth employer contribution. However, it's going to be treated as a Roth conversion on the employee side, meaning that you are going to have to pay taxes on that $25,000 and treat that as an end plan conversion. So even though it goes directly into the Roth solo 401k as a Roth solo 401k employer contribution, and the corporation, the LLC tax and S corporation gets that $25,000 deduction on the business side, it's going to be treated as a taxable event on your personal tax return. It's going to be treated as an end plan conversion. So you're going to have to pay taxes on $25,000, which could bump you into a higher tax bracket. Okay, so that's how employer contributions work. Now, as far as voluntary after-tax solo 401k contributions, which is another type of contribution, voluntary after-tax contributions are dollar for dollar when performing the contribution calculation. So just like employee contributions are a dollar for dollar calculation, the same is true for voluntary after-tax solo 401k contributions. And again, the voluntary after-tax solo 401k contribution is part of the mega backdoor Roth strategy. So oftentimes, clients will solely make voluntary after-tax solo 401k contributions and forego making employee and employer contributions. For example, the overall contribution limit to a solo 401k plan for tax year 2025 for those who are under age 50 is $70,000. That means that the $70,000 applies when you go to make any of these contribution types, that is employee, employer, or voluntary after-tax solo 401k contribution. In short, you have to aggregate all these contributions and you cannot go over that overall limit of $70,000 when making contributions. So one scenario is, okay, I'm going to forego making any employee and employer contributions, and I'm going to maximize my voluntary after-tax solo 401k contributions. So using the LLC tax as an S corporation example again, let's say you pay yourself just $70,000 of W-2 wages for tax year 2025 from your self-employed business. You can contribute that entire $70,000 as a voluntary after-tax solo 401k contribution. So that would go into the voluntary after-tax solo 401k bucket. And then you would turn around and convert that $70,000 to the Roth solo 401k or to a Roth IRA. But you would not be able to contribute anymore because you're under age 50, number one. And number two, the overall limit for contributions to a solo 401k for tax year 2025 is $70,000. And third, you only reported 70,000 of W-2 wages. But even if you reported more than 70,000 of W-2 wages, let's say 75 or 100,000, it wouldn't matter because you cannot contribute more than the $70,000 limit. And if you apply that entire $70,000 to the voluntary after-tax solo 401k as a voluntary after-tax contribution, then you will have already exhausted the maximum overall contribution limit to the solo 401k for tax year 2025. Now, a second scenario is you can contribute some voluntary after-tax solo 401k contributions, some employer contributions as well. So let's say you pay yourself $100,000 of W-2 wages from the LLC tax as an S corporation. Again, you're under age 50. This is for tax year 2025. So let's say you want to make employer contributions. So it's 25%. Well, let's say you pay yourself $100,000. The employer contribution is percentage based. So it's 25% of 100,000. So you can put $25,000 in as an employer contribution. And then you can put the difference up to $70,000 as a voluntary after-tax solo 401k contribution. So what? Subtract 25,000 from 70,000, you can contribute $45,000 as a voluntary after-tax solo 401k contribution. So $25,000 as an employer contribution would get applied to the pre-tax solo 401k bucket. The $45,000 in voluntary after-tax solo 401k contributions would get applied to the voluntary after-tax bucket, and then you would convert that to the Roth solo 401k or to a Roth IRA. So those are just some scenarios regarding making contributions. But again, the takeaways are: one, you cannot contribute more than $70,000 as an annual contribution to the solo 401k for tax year 2025. Second, you have to have enough W-2 wages from your self-employed business to justify the contributions. And third, you can break down the contributions by contributing some employee, some employer, some voluntary after-tax, or you can just make voluntary after-tax contributions and forgo making the other contribution types. So that's how it works with regards to contributions to a solo 401k plan and the various contribution types. Okay, let's take a look at some other. Give me a moment here. Let's take a look at this slide here and go over some more items, which again, today's main topic is how much can I put in to a solo 401k plan? Go ahead and shoot over any questions you have during the live webinar. It doesn't have to be about this topic specifically. And we'll pause and answer those questions as they come in. Okay, so we already went over the first bullet point there. We also went over the current IRS contribution limits. Now we're going to talk about catch-up contributions for age 50 and older, as well as super catch-up contributions for age 60 through 63. And let me share my screen. Give me a moment here. So scroll down. Okay, so there is a catch-up contribution, which is $7,500 for tax year 2025. It remained the same. It was also $7,500 for tax year 2024. And then there's the super catch-up contribution, which is new, starting in tax year 2025. And that one there is specific. It's $11,250, but it only applies to those who are age 60, 61, 62, or 63. So let's talk about the normal catch-up contribution of $7,500. Let's say that you are using my prior example. Let's say your self-employed business is an LLC, taxed as an S corporation, and you want to maximize your mega backdoor Roth solo 401k strategy for tax year 2025. So therefore, let's say you pay yourself $100,000 of W-2 wages from your self-employed S corporation. Based on $100,000, you can choose to make a $70,000 voluntary after-tax solo 401k contribution for tax year 2025 because it's a dollar-for-dollar calculation. And obviously, you're reporting $100,000 of W-2 wages, which is more than enough. So you would contribute that $70,000 to the voluntary after-tax solo 401k bucket, so this bucket right here. Then you would convert that to the Roth solo 401k. Now you might ask yourself, well, I'm over age 50 and I'm clearly reporting enough W-2 wages. I'm reporting $100,000 of W-2 wages from my self-employed business. can I go ahead and also treat the catch-up contribution of $7,500 as a voluntary after-tax solo 401k contribution and then convert it to the Roth solo 401k? The answer is no, you cannot do that. Why? Because voluntary after-tax solo 401k contributions only allow for making contributions up to the $70,000 limit. You cannot contribute more than that. However, you could treat that $7,500 as a employee Roth solo 401k contribution. So you would make that $7,500 contribution directly to the Roth solo 401k bucket. So the holding account for the plan, the Roth solo 401k bucket right here. It would not go to the after tax, but rather the Roth bucket directly. And now you would end up contributing a total of $77,500 for tax year 2025 to the solo 401k, consisting of $70,000 to the voluntary after tax solo 401k bucket, which then gets converted to the Roth solo 401k. So it goes into this bucket and then to the Roth as far as the conversion. And then the $7,500 catch up, you would contribute that directly to the Roth solo 401k bucket. Or if you want to treat that catch up contribution as a pre-tax employee contribution, you would make it to the pre-tax solo 401k bucket, and that would reduce your taxable income for the year by $7,500, the catch-up amount. The takeaway is that you can never treat catch-up contributions as a voluntary after-tax contribution. That always has to go to the Roth bucket or the pre-tax bucket. It can never go into the voluntary after-tax bucket. Okay, let's talk about the super catch-up contribution. So if you're age 60, 61, 62, or 63 in tax year 2025, the catch-up contribution has effectively increased from $7,500 to $11,250. In other words, you can't contribute both. It just increased. The amount has increased to $11,250. $11,250 for those who fall within that age category of 60, 61, 62, or 63. So that's just like before. If you're looking to maximize your voluntary after-tax solo 401k contributions and you pay yourself $100,000 of W-2 wages from your self-employed S corporation, then again, you could treat the entire $70,000, the overall limit, as a voluntary after-tax solo 401k contribution. So it would go into this bucket here, and then you would convert it to the Roth solo 401k, or it can be converted to a Roth IRA instead. Now, the $11,250 catch-up amount, that cannot be deposited to the voluntary after-tax solo 401k bucket. That can only go into the pre-tax employee bucket or the Roth employee bucket. So you could choose to contribute that $11,250 super catch-up amount directly to the Roth solo 401k, or you can contribute it to the pre-tax solo 401k instead, and you would get a tax deduction since you would make that as a pre-tax contribution. All right, looks like we've got another question here. Let's take a look at that question, and then we'll come back and continue with our presentation today, which is how much can I put into a solo 401k? Let's see here. I have sent an email to George and you earlier today with the calculations. Search for subject for Go Cloud. Appreciate if you could please confirm the details mentioned in the email. I'll have to jump. Okay, no problem. We'll go ahead and respond accordingly. Okay, so as far as any other questions, I don't see any other questions thus far. Let me go ahead and share some more information here regarding today's topic, which is how much can I put into a solo 401k plan? We've been talking about this topic at great length thus far. Go ahead and type over any questions you have regarding any aspects about solo 401k, IRAs, or Rob's 401k, and we'll answer those questions as they come in. So we already talked about these first 4 bullet points. Now, solo 401k versus other retirement plans. So the solo 401, we often get the question, should I open a solo 401k plan or should I open a SEP IRA? So oftentimes we explain to clients the difference between the SEP IRA and the solo 401k, and they understand that the solo 401k is probably the best route to go for a few reasons. Number one, a SEP IRA only consists of employer contributions, whereas the solo 401k allows for both employer contributions as well as employee contributions. Also, the solo 401k allows for the mega backdoor Roth solo 401k and therefore voluntary after tax solo 401k contributions. The SEP IRA does not allow for the mega backdoor Roth solo 401k strategy, nor does it allow for voluntary after tax contributions. What is more, from other aspects, the solo 401k is better than the SEP IRA because you can take a loan known as the solo 401k participant loan. You can take that loan from a 401k, including a solo 401k. SEP IRAs are technically IRAs, so they do not allow for participant loans. Another big difference is in the context of making alternative investments, specifically real estate. While some SEP IRAs you can invest in physical real estate like rentals, with the solo 401k, you can invest in rentals as well, and you can utilize what's referred to as debt financing, also known as a non-recourse loan, where the solo 401k gets a loan to invest in real estate, such as a rental property. Under that type of arrangement, if you do the same with the SEP IRA, where the SEP IRA gets a non-recourse loan for investing in a rental property, that's going to subject the SEP IRA to a tax known as unrelated debt finance income tax, which is oftentimes taxed at a 38% tax rate. Well, that tax does not apply to solo 401k plans that leverage financing for investing in real estate, like real estate rentals. So that's a huge difference for those that like to invest in real estate with their retirement accounts. What is more, if you're looking to open a solo 401k plan for the first time in 2025, and you're trying to decide between a solo 401k and a SEP IRA, the solo 401k has what's referred to as an auto contribution credit, which does not apply to SEP IRAs. The auto contribution credit is a way of the government subsidizing the cost of having a solo 401k plan for many years. The way it works is that for 3 consecutive years, you can take a tax deduction on the business side of it's a dollar for dollar. And it's actually not a tax deduction, it's a credit. So it's a $500 credit for 3 years, 3 consecutive years. So if you open up a solo 401k plan in tax year 2025, you would get a $500 credit just for having a solo 401k, a second $500 credit in 2026, and a final $500 credit in 2027 for a total of $1,500. And you need to make sure you open up a solo 401k plan from a plan provider such as my solo 401k financial, because not all plans come with that auto contribution credit feature. And you don't have to contribute to the plan in order to qualify for it. You just have to have a plan that has the appropriate language to allow for it, and you file Form 8881 each year to claim that $500 credit. That's known as the auto contribution credit. Also, if you already have a solo 401k plan like Fidelity or Schwab, and you want to restate that to our plan, we can add that auto contribution credit to your plan so that starting this year, you would qualify for that $500 credit for 3 consecutive years for a total of $1,500. Lastly, the credit really didn't become available till the end of 2024. So if you're an existing client of my solo 401k financial that opened a solo 401k plan with us prior to that December 31st year, we can update your plan so that now you qualify for that auto contribution credit for 3 years as well. You would submit a support ticket through our website so that we would collect the necessary information to so that you qualify for that auto contribution credit. We would need to add that feature to your plan. Let me send over a link to our support ticket. Okay. See if we have any other questions for now. Looks like we have a question here from Keenan. Thanks for sending over your question today. The question is, if I can make the screen a little bigger here. If I open a retirement trust account, how do I differentiate track between pre-tax, Roth, after-tax, or rollover inputs? Great question. And let me share my screen as well to help answer your question. So here's an example of a two-participant plan. And let me share a different screen to illustrate my answer to your question here. Okay, so with the solo 401k plan, here's an example of a one-participant plan. And here's an example of a two-participant plan. Let's talk first about a one-participant plan. With a one-participant solo 401k plan, first, the solo 401k plan is sponsored by the self-employed business. So let's say you're a sole proprietor and you open a solo 401k plan. That means it's just one solo 401k plan that allows for various contribution types. And to separately track those contribution types, separate holding accounts are open under the solo 401k plan. For example, many of our clients who open a solo 401k plan will use Fidelity Investments for the holding accounts, that is the brokerage accounts for the solo 401k that we offer. And don't get confused, because Fidelity also offers their own solo 401k, but it does not allow for voluntary after-tax solo 401k contributions, and thus to make it back to a Roth strategy. But they will provide what they refer to as investment-only non-prototype brokerage accounts for a self-directed solo 401k offered by my solo 401k Financial, because they know it's our plan that allows for them to make it back to a Roth strategy. So using the Fidelity Investments illustration, let's say you use Fidelity Investments for the brokerage accounts. We would help you to open up 3 separate brokerage accounts for the one solo 401k plan over at Fidelity. Let's say the name of the solo 401k is Palm Trees Retirement Trust. So the plan name is Palm Trees Retirement Trust. The first brokerage account at Fidelity would be titled Palm Trees Retirement Trust, labeled pre-tax in parentheses. The second brokerage account would be labeled Palm Trees Retirement Trust with the word Roth in parentheses. And the third brokerage account would be titled Palm Trees Retirement Trust with the word after-tax in parentheses. That would be the voluntary after-tax holding account. So with the solo 401k, because it's a defined contribution plan, you have to separately track each participant's funds and each source of funds, and that's done by opening up separate holding accounts, aka brokerage accounts or bank accounts, to hold those respective contributions. If you transfer a former employer pre-tax 401k to the solo 401k, that would flow into the pre-tax bucket. If you transfer a former employer Roth 401k, that would flow into the Roth solo 401k bucket. So that's how it works with regards to tracking each contribution types for a one participant plan. Now, if we're talking about a two participant plan, well, many of our clients are married. So naturally, there's both spouses working the same self-employed business. So they would each um, participate in the same plan. So just one solo 401k plan, but now you would have a total of 6 separate brokerage accounts, aka holding accounts under the solo 401k plan to hold their respective funds. So it's still considered one solo 401k plan. Now, I want you to be aware that there are some solo 401k companies out there that will charge you double the price just for having one solo 401k plan, and they'll try to be kind of cute and sneaky about it, where they make you open up 2 separate solo 401k plans so that they can double up on the fees, so that they can charge you 2 setup fees and 2 annual fees. And in that scenario, you're talking about an LLC, for example, where both spouses work for the same business. They'll say, well, you're going to have to open up 2 solo 401k plans. So now you're going to have to file 2 separate 5,500 easies. We're going to charge you 2 separate fees. Well, that's not number one. That's not allowed under the IRS regulations. And number two, that's terrible. They're nickel and diming you unfairly because they shouldn't be charging you double for fees because it's only one plan. Why? Because the plan is sponsored by the self-employed business. Therefore, it's just one plan. You are both participants in the plan. So each of you have separate holding accounts under the plan so that you can make contributions and transfer funds into the plan. So it's not 2 separate plans. It's a similar example is, let's say you work for the Home Depot. Well, the Home Depot offers a 401k. All of their employees participate in the Home Depot 401k. So they each have a separate participant account under the Home Depot to hold their funds. Same concept with the solo 401k. If you're both self-employed in the same business, it's just one solo 401k plan, one fee, and one type of reporting. So be aware of solo 401k companies, and there's actually a lot of them that are doing that now. I don't know if they saw other companies do it, so now they're thinking they can go ahead and really make more money by unfairly trying to charge you double just for having only one self-employed business where you both work. It should only be one plan. All right, so we want to make you aware of that. But good question. Let's see if we have any other questions here. All right, looks like we have a follow-up question here. So you would open 3 different retirement trust accounts and label them as such and track between the segments? No, it's not. It's not 3 separate retirement trusts. It's one retirement trust. Keep in mind the word retirement trust is another way of saying solo 401k. A solo 401k plan is a retirement trust. So it's one retirement trust with separate holding accounts. So one retirement trust, 3 separate bank or brokerage accounts under that retirement trust to hold your pre-tax Roth and voluntary after-tax contributions. If it's both spouses working in the same business, it's still one retirement trust, aka solo 401k plan with 6 separate brokerage accounts under that one solo 401k, aka retirement trust, to hold both spouses' funds in the plan. Okay, so you're welcome. All right, so go ahead and continue to shoot your questions over, and we'll pause and add and answer those questions as they come in. Again, today's topic is how much can I put into a solo 401k plan? Let's continue and go ahead and like today's video, subscribe to our YouTube channel for more videos like this. Go ahead and shoot over your questions as we're coming to the end of our session for today. Let's see if I can make this window a little bigger here. Okay, so We talked about various items regarding a solo 401k as far as how much I can put into a solo 401k plan. And why does this matter? Well, a solo 401k plan was created by Congress to level the playing field between full-time employers that offer traditional 401k plans, as well as solo 401k owners, or I should say self-employed individuals that want to save for retirement. So the solo 401k was created specifically for owner-only businesses. And a solo 401k allows for high contributions, just like a full-time employer plan allows for high contributions. And that's why it's oftentimes the retirement account plan of choice for not only big Fortune 500 companies, but now the self-employed. So it opens up powerful tax planning opportunities. One example of that, as we talked about, is the solo 401k allows for the mega backdoor Roth solo 401k strategy, where you can maximize your annual contribution to that voluntary after-tax solo 401k, which is $70,000 for tax year 2025, and then turn around and convert that to the Roth solo 401k or the Roth IRA. So it's a way to really maximize your tax-free growth, because Roth solo 401k funds grow tax-free, just like Roth IRAs. Especially if you think we're going to be in a higher tax bracket down the road, then you definitely want to be able to take tax-free distributions from your Roth solo 401k, and the mega backdoor Roth solo 401k is a great strategy to really supercharge those Roth IRA or Roth solo 401k gains indirectly. So again, you can choose between immediate deductions or long-term tax-free growth, meaning you can make pre-tax solo 401k contributions. Those result in lowering your taxable income for the year. Or you can make Roth solo 401k contributions and or voluntary after-tax solo 401k contributions, which are not tax deductible, but the trade-off is that the Roth solo 401k funds grow tax-free. And if you make a voluntary after-tax solo 401k contribution, you can then convert it to the Roth solo 401k or the Roth IRA so that it grows tax-free. So that's why the solo 401k plan is the ultimate retirement account for the self-employed, because not only from a contribution perspective, you can also invest in alternative investments like private equity, real estate, whether commercial, residential, or land, promissory notes, tax liens, precious metals, whether gold or silver, and of course, cryptocurrency. And you can also invest in equities as well. And on top of that, you can also borrow from the solo 401k plan through a participant loan, and you pay yourself back. So that's why the solo 401k is often referred to as the ultimate retirement plan for the self-employed. All right, it looks like we don't have any other questions for today. As always, please like our video, subscribe to our channel so that you receive notifications when we go live. And until next time, have a great rest of the day. Bye-bye.